Well, it's natural for people to think their own civilization and their own nation is better than everybody else. But everybody can't be better than everybody else. You're right, China's economic record among the big nations is the best that ever existed in the history of the world. And that's very interesting. A lot of people assume that since England led the Industrial Revolution and had free speech early, that free speech is required to have a booming economy as prescribed by Adam Smith. But the Chinese have proved you don't need free speech to have a wonderful economy. They just copied Adam Smith and left out the free speech, and it worked fine for them. As a matter of fact, it's not clear to me that China would have done better if they'd copied every aspect of English civilization. I think they would have come out worse because their position was so dire and the poverty was so extreme. They needed very extreme methods, totalitarian methods, if you will, to get out of the fix they were in. So I think what China has done was probably right for China, and that we shouldn't be so pompous as to be telling the Chinese they ought to behave like us because we like ourselves and our system. It's entirely possible that our system is right for us and their system is right for them.
Warren Buffett's right-hand man, Charlie Munger, loves China. As you can see from his latest daily journal portfolio, he had particularly added Alibaba stock. The tech giant represents the third largest position in Munger's extremely lean portfolio, at a market value of over $37 million and makes 17.6% of the whole portfolio. This video uncovers why Munger is going all in on Alibaba at a time when many would fold to uncertainty. First and foremost, Munger is a classic value investor. At the end of the day, he wants to hold high-quality companies that are underpriced below intrinsic or book value. Debate continues over if Alibaba is that good of a company to invest in just because it is a cash-generating machine. Alibaba is responsible for $1.2 trillion of gross merchandise export per year from China. The company attracts over 891 million active annual customers on their various platforms in China. They also own Alipay, an app that transfers money through digital payments that has around 1.3 billion annual active users. To put that number into perspective, there were 186 million Twitter users in 2020. So we are talking over 9 times as many users as one of the most popular social media websites in the world. Alibaba currently has more than 80 million merchants and 2,000 partnered financial institutions. You know, particularly in the case of Alibaba, they pay around $4.5 billion of tax per year. And on top of that, every transaction made on their e-commerce outlets carries taxes in and of itself. In other words, Alibaba is a huge money maker for China. Not only does this obvious fact hold true for the present, but the future looks extremely bright as well. If we look at China's production abilities as a whole, the United States government-owned Congressional Budget Office estimated that China's economy would expand from 70% of the US GDP in 2020 to 76% in 2025, and more than 85% in next 10 years. Nasdaq's website goes one giant step further, predicting that China will become the largest economy by 2028. And its per capita income should rise by 50% from 2020 to 2025. CNBC reports that China's middle class is expected to expand to 55 million people in the near future. In other words, if China's future middle class was its own country, it'd be the third largest by over 150 million people. There are going to be an insane amount of working-class citizens who are exposed to and directly impacted by Alibaba's services every day. Many people, through either necessity or having expendable income, will use the products Alibaba offers at a rate that's hard to imagine. Consider not just the aspect of selling products, but Alibaba's impressive cloud business as well. It has about 40% market share in the Chinese cloud infrastructure services, as for first quarter of 2021. I think that's crucial to Alibaba's potential, because even when the global workforce returns to some level of normalcy, I think globally, eyes have been permanently open to the efficiency of cloud technologies. which are exploding in scale and demand, and we will continue to do so in an increasingly digitized world. These factors spur tons of value for Alibaba. When viewed through bullish eyes, intrinsic value, oftentimes referred to by economists as true value, is an objective valuation of an asset that derives from measurables that encapsulate economic entirety, i.e., earnings and profitability in relevant economic conditions, on a macro level, and within the specific asset sector, and performance trends. Speaking of the stock being undervalued, let's talk about some of those numbers, which I'm sure attract Munger, as an old-school value investor. Now with Alibaba, over the past 10 years has grown its revenue at a compound annual growth rate of 60%, and free cash flow is $23 billion US. Free cash flow is how much money is available at the end of the business cycle from period to period. A lot of times these focus on annual free cash flow, tells us that it has the full ability to pay its expenses for the foreseeable future, and gives a hopeful look at profitability. The stock currently trades around the 160 Hong Kong dollars per share, although it's been decreasing with the fears of Chinese restrictions. I've talked about this in other videos, and will briefly touch upon it again. Munger certainly isn't the only super investor banking on that prediction coming true. According to Dataroma, which tracks 72 of the world's biggest super investors, Alibaba was the biggest buy from Q2 with 17 super investors buying the stock. It now ranks up in the top 10 most held stocks in the smart money portfolio. For instance, here's what value investor Manish Pabrai thinks about Alibaba.
It's an incredible business. Just if you look at Baba and Tencent and kind of where they're at, and the ecosystem and the moat and what they control, and all of that. Look at the tailwinds from China. There's a lot to me to like, even more than the large US tech. Just because I think that the tailwinds are so much stronger, and there's some serious barriers to entry.
Obviously, high-level investors are going to do their own intense due diligence in investing to fulfill their own needs. But at that level, we know many of these investors are closely connected with each other. And when someone like Charlie Munger, who has been Warren Buffett's right-hand man, makes such a strong declaration for a company, you can bet the house he is not doing it blindly, and on principles he has been following for years. Of course, that doesn't stop those of us with far smaller bank accounts to reason that there is way too much volatility stemming from regulation risks and lack of trust to invest in Alibaba. Even if we push China's tight restrictions on Alibaba aside, there's the issue of even trusting Alibaba's performance numbers. China doesn't even let United States regulators to audit a Chinese firm. However, Alibaba do maintain a pretty solid track record of consistent cash flows. Being backed by Goldman Sachs, SoftBank, and even being owned by Yahoo, shows that the Chinese tech firm is a legit investment. In the mid-2000s, Alibaba started filing with the SEC to gain more trust from investors. Alibaba's numbers seem very trustworthy, but the people who are in charge of the government are a bit sketchy. There's no doubt that one of the biggest risks in entrusting Alibaba in anyone's portfolio right now is China's ongoing love-hate relationship with the company and tight restrictions on the Chinese tech sector. All of this started when CEO Jack Ma voiced his intention to essentially use Alipay as a means to give more power to the people than China's extremely powerful and nationalized banks. Ma accused Chinese banks of operating with a pawn-shop mentality. He had also claimed that the authorities were trying to use the same ways they used to manage a railway station to provide modern finance solution. Because of this, Chinese regulators had to involve in the company's management, and this caused Alibaba's market share to fell over $75 billion, and Ma ultimately went missing for 3 months. On the other hand, Munger dissents from this opinion, actually speaking out against Ma, and here's what he had to say on the matter.
I think Jack Ma was very arrogant to be telling the Chinese government how dumb they were and how stupid their policies were and so forth. Considering their system, that is not what he should have been doing.
You can clearly see Munger isn't bothered by China's response. The big reason many like him shared that opinion reverts to the huge revenues and tax dollars Alibaba generates for China that I mentioned near the start of this video. Alibaba and Tencent are arguably China's biggest cash cows. Alibaba has been called China's golden goose, and what's good for the goose is certainly good for China. Add up all these factors, and it sums up why I think Charlie Munger continues to believe so strongly in Alibaba when many stay away. I'd advise all of you to do your own due diligence, as always be extremely cautious when investing in any foreign company. Only invest what you're comfortable losing if you do make the long-term play, like Munger is making. Let us know in the comment section below. Don't forget to like the video and subscribe for more informative, hopefully entertaining coverage on the world of business and investing.